What's up, guys? Gardner here. Have you ever gotten a message like this from a new investor who's maybe the first time landlord? They're not really sure what they need to know. I got this message literally last night, and I told them you need to understand the difference between appreciation and depreciation. So let's jump into it. So let's say, use an example here. You bought a $300,000 property. What I like to break it down in understanding there's what I call sale value and then what I call IRS value or tax basis. Let's talk about the sale value first. The sale value is what we all understand as what we call appreciation, right? So you can see the graph here. This is the median sale prices in the U.S. over the past 30 or so years since 1990. And you can see in general, the values of property generally rise. Average is about 3 to 4% per year. There's peaks and there's valleys. Of course, there's dips as it goes. However, in general, the property in real estate will go up, is what they say. So let's use this as an example for appreciation just to hit that point home. So a $300,000 property, here's $300,000. When we're talking about the appreciation side or the sale price side, how does that look like over 5 years? In year one, if we appreciate 3 to 4% on average, you're looking at roughly $10,000 a year at this purchase price. And so here we are. Year one, we're adding $10,000. Year two, year three, year four, year five. And here we go. That $300,000 property is now worth $350,000. Voila, appreciation. Everyone generally understands how that works. But what about this whole other concept of IRS value or depreciation? And it's really kind of the IRS nerds or the CPAs out there that could really teach you this. But again, I'm not a CPA. It's a big caveat here. I'm not trying to give you tax advice. I'm just trying to teach you the basic concepts here. All right. What is it though? It's basically a phantom expense, right? This is the IRS giving you a gift for the wear and tear that you're going to experience on your investment property. And depending on the type of property you have, it's going to either be depreciated over 27 and a half years or 39 years. But again, not get into the weeds here. This is the big picture understanding. So let's break it down to show you that same property of $300,000 that you bought it for, how does the depreciation work on that same property? The first thing you need to realize is that land does not depreciate. So according to the IRS, land is land is land. And so you're not going to be able to depreciate that aspect. You can only depreciate the improvements that you put on the land. So in this case, let's say that the land value is worth $25,000. And so what we're left with is $275,000 that we're able to depreciate. And in this case, we'll say it's a traditional long-term rental for a single-family house, which, if that's the case, it'll depreciate over 27 and a half years. So we're able to depreciate $10,000 per year out of this property. And over the course of 5 years, what does that look like? We're looking at roughly $250,000 left that we can depreciate out of that property after 5 years. Why does this matter, though? Is it important at all? The thing you need to realize is what this depreciation does. Again, it's a phantom expense that helps you offset your rental income. So if you were to make $10,000 this year in this property, and you can depreciate $10,000 from the property as well, even though you made 10 grand, you're actually not paying any taxes because they offset each other. So it's great. So you actually realize $10,000, you have this $10,000 phantom expense, and you have no tax to pay on the profits that you made, which is pretty cool. It also carries over to future years. So it's nice. If you were to make only $5,000 in this year and you have a $10,000 depreciation, you actually will then have a $5,000 loss that you can carry over to the future years, which is awesome. So it's not like you're going to hurt yourself if you depreciate too much. There are some things to realize when it comes to depreciation recapture, but just for the concept now, we're going to keep it simple. All right. The other thing you can realize is you can really maximize these savings. There's what we call a cost segregation study that most savvy investors are going to do with a lot of their properties, where you can accelerate this depreciation through accelerated and bonus depreciation. Again, touching the surface here, but now you hopefully realize the difference between appreciation and depreciation. If you want to find out more or sign up for my newsletter, go to roargardner.com. Talk to you guys soon. See ya.